Yesterday in the video that I did, I featured Mike Wilson from Morgan Stanley and his view of what's going to happen this year. He got it right in some aspects of last year, and he got it wrong in some others, and he covers that. What I wanted to mention today was really my view of his thoughts, and that is, that which I agree with, is that we're going to have a fairly rough ride this year, but it will probably, according to Wilson, probably end positively. So he believes we should expect a positive year, but don't go there so quickly. Think of the first 6 months as being probably negative. With that view, I'm going to jump into the dashboard and cover what went on this past week. This last week was the first week of the year. So mostly the view was the last week, and year to date is approximately the same number. So you can see that all of the averages, the S&P 500, the Dow, the Russell 2000, the NASDAQ 100, and the foreign markets and developed and underdeveloped markets, all negative. So that affected the 20-day moving average, which is the first column of dots to the right. So you see 4 out of the 6, actually 4 out of the 7, because I included treasuries in here as well. So 4 out of the 7 were, 5 out of the 7 were negative and 2 were positive. So we're off to a negative start for the year. We don't know. Is that going to affect the rest of the year or not? We'll find out. For the last 2 years, January, the first start, the first week, yeah, that seemed to be the omen for the year, but I would not necessarily say that's going to be the case. So on the year to date, going from the Dow being down only 0.6%, all the way down to the Russell 2000 being down 3%. So the Russell is, while it has rallied during the last part of 2023, it is struggling during 2024 so far. Okay, when we break apart the sectors, again, the same thing happened. We see 6 of the 11 were negative, meaning the moving average, the index was below the 20-day moving average, and 5 of those were still above the 20-day moving average. As you go to the right of that, on the dots to the right, you see the 50, the 100, and 200. Most of those were still above the moving average. So when you look at I'll just look at the year-to-date numbers, you can see that 8 of the 11 were negative, 1 was barely positive, and 2 were distinctively positive. When you look at what was the top sectors, they are all defensive sectors. Healthcare, energy, financials to some extent, and consumer staples. Certainly at least 3 out of the 4 are defensive sectors, and those did the best for the year. So no surprise in a negative start to the year that the best ones will tend to be defensive. Okay, the S&P 500, this is an 18-month chart, and you can see I drew a line from October to present, so that gives us about 15 months. And you can see at the far right of the chart, the upper right corner, you can see the drop. That's the drop that occurred in the first week of January. Growth and value. So far, since October, value has been in favor. These are more earnings-oriented companies as opposed to sales-oriented companies. So you can see the direction. I put a black arrow to show you the direction, including the last week. You can see how sharply it's down, which tells you the degree to which value is in favor, or the degree to which growth is out of favor. But from the beginning of 2023 up to October, it was pretty much growth stocks were in favor. The S&P 500 SPY is the ETF compared to, relative to, small cap ETF, IWM. Large cap came into favor. And for the last 2 weeks, large cap was more in favor than small cap, to the degree that the line went up at the end of the chart. So you saw the numbers before of how much out of favor, how much loss the small cap was relative to large cap by quite a bit, and this shows it graphically. Long-term government bond also had a down week, and it has been down for quite a period of time. This is a 42-month chart. It was down before that, but it again has been going up since October, but then again a week at the very end of it where it went back down again. So I don't know the direction of that. What I do know is that if interest rates go up, bond prices go down, and vice versa. The dollar. The dollar has basically been in an upward trajectory. There's a lot of patterns here, both down patterns, up patterns, indecisive patterns. So, but I'd say the dominant pattern is the dollar is moving in an upward direction for the last 30 months. Gold was down a little bit for the week, but since October, November of last year, or the year before, you can see that it's basically been in an upward trajectory. Silver has not been doing as well. It's been going up and down, but really not a specific pattern. It had a down week that was more so than gold, and it is more out of favor than gold. So, but if you looked at it and said from a year and a half ago, yeah, it's up, but not in very much of a decisive pattern. When I put silver and gold in a relative strength chart showing silver as the numerator, gold as the denominator, meaning that if it goes up, it favors silver. If it goes down, it favors gold. And you can see, and I drew an arrow here because there is a pattern that silver is relatively to gold weaker. Bitcoin continues to do well, going from November of 2021 or 2022 to present. You can see definitely an upward trajectory to Bitcoin. And it appears that this year, most people agree that this year Bitcoin is expected to have a very good year. Volatility index, the VIX, has been in a downward trajectory, which is favorable for equities. However, this past week, because it was a negative week, the volatility index moved up again. So, but not a lot. So that gives you the degree of that. I put my arbitrary line at 24, where I consider if it's moving up above that, that's usually a bearish sign. So it's a long ways away from that 24 arbitrary indicator. Asbury Research publishes their Asbury 6 metrics, and 2 of those are negative, and 4 are positive. And so it's generally still in a positive mode, but has moved from 1 negative indicator to 2. Their cross-asset, Asbury Research, cross-asset relative performance chart shows the following, that blue chips are more in favor than, meaning the Dow, more in favor than the broad market. We saw that in the first set of indexes, that the lowest loss was from the Dow Industrials. The broad market, the S&P 500, has done better than the NASDAQ 100, the tech-heavy index. Value, we clearly saw this, is way in favor over growth, and developed markets are more in favor than the U.S. market. U.S. versus the world. The countries that are more doing better in the last week, the last month, the last quarter than the U.S. are Brazil, Canada, Mexico, Switzerland, Italy, Spain, India, and New Zealand. The ones where the U.S. is doing better, U.S. is doing better than, in all three time periods, Chile, France, Hong Kong, Singapore, Taiwan, South Korea, and China. So a mixed bag, but you can see a little bit of a pattern there. And the one I picked to show you was Spain, to show you how it's doing better than the U.S., and it's the one that had the clearest pattern. So you can see this is a relative strength chart showing Spain, and this goes back, let's just say, to October of last year, so about 15 months. You can see clearly there is an upward trajectory, the degree to which Spain is outperforming the U.S., and that's using the ETF EWP relative to SPY for the U.S. Gold and silver. So as of Friday, the spot price of gold was $20.49. Spot price of silver, $23.25. That represents 0.3% drop in gold, but a 4% drop in silver. You saw that in the previous charts for gold and silver. The ratio is 88-1, definitely favoring silver as a better value than gold. It's rising, so we're getting to the point where silver becomes quite a good value. The monster box, which is 500 rounds of silver, you can buy a monster box for $12,765, or at least you could have on Friday. And the spot price, I've told you, is $23.75, and the markup is $2.28. That's what at least my son Preston charges for it. And you can use that as an as a benchmark if you want to, if you're shopping and you want to look at local, which I recommend, local sellers versus internet. Too many people have been burned over the internet, so I don't recommend that. But go to a local retailer that you trust, that is brick and mortar, has been there for a long time. That's a good way to buy it. But this gives you a benchmark. So when you look at a monster box, 500 rounds is $25.53 per round, and that goes up 50 cents per round if you bring it down to a tube of 20. So the therapist, the psychiatrist, is talking to the market and Janet Yellen. Your problem is you two are codependent. Makes sense to me. Thank you for watching. If you have any questions or comments, leave them in the comment section below.